Hi friends, welcome to my 10 cent. Today we will talk about a very interesting question. Is gold a good investment? Now, throughout our childhood to the adolescence, teenage and adulthood and as family members, one thing which we have always had a fascination towards is gold. In fact, I have covered an entire video on man's fascination and the reason why we are fascinated about gold separately, and you can check it in my description, and I would urge you to watch that. But fascination aside, all of us are fascinated with gold. In fact, we can remember our parents and grandparents accumulating gold. In fact, Akshaya Tritiya is a big occasion where a lot of families, in fact, many of the families ensure at least they buy some gold on Akshaya Tritiya. It's almost like a festival, right? And if you go down to south, whether it's Diwali, Onam, people always have a fascination for acquiring gold. Now, when you do all of this, hand on heart, haven't you at least thought once, all this money I'm putting into gold, is it worth it? Is the gold really a good investment? In this video, you will find answer to that. We will talk about how the supply and demand of gold works globally, how has gold performed historically, and how is gold compared to other investment options you have like real estate, stocks, bonds, etc. etc. Stay tuned. This video will answer that question, is gold a good investment? Now, first, let's look at the demand for gold. Every year, the annual demand for gold, as estimated by World Gold Council, is about 4,400 tons, give or take. Now, you must be wondering, wow, 4,400 tons of jewelry is consumed every year? That's not the case. No, we don't consume that much of jewelry. If you look at 4,400 tons, as you can see in the table, about 50% is towards jewelry. Okay, about 5 to 7% goes into technology, satellite equipments, etc. In fact, this 7% is the only real industrial consumption for gold. Right, the rest is all our fancy for gold. Right, so 50, 55, 57% goes into jewelry and industrial applications. The remaining 45% is what we call it as the investment requirement for gold. Now, what do I mean by investment requirement? Investment requirement means people like you and me, individuals who buy gold coins, gold bars purely for investment, be it in the form of physical gold coins or digital gold investment, and don't bother about digital investment. In case you don't know how to invest digitally in gold, we will cover that in a separate video. But investment in gold purely to get returns. Okay, that plus, remember, we are not the only people who are buying gold. One of the biggest buyers of gold is governments, countries. They also invest in gold a lot. So together, individual plus government plus institution plus corporate investment in gold accounts for 45% of the gold demand. So out of 4,400 tons of gold consumed every year, not consumed is the wrong word, the demand that is there for gold every year, 50% jewelry roughly, 5 to 7% technology, and 45% goes for from the investment purposes. And this demand has been growing very steadily over the course of last 10 years, roughly at about 0.5%. Not a fantastic growth. So growing steadily, but consistent demand for the last 10 years. Now, how is this demand met? Now, where is the supply of the gold coming from? I don't know whether you watched the earlier video about fascination of gold, which we've covered in detail. Gold is an alien material. Gold does not form on our planet. Whatever gold that is there in our planet is finite. You cannot have more gold. And the estimate is the mineable gold in the planet is about 250,000 tons. That is 250,000 tons, give or take. Of which 80%, that is 2 lakh tons or 200,000 tons, has already been mined and is in circulation. Every year, we mine about 3,500 tons. So for the 4,400 tons of demand, 3,500 or thereabout is met every year through fresh mining. What about the balance 900? That comes through recycling of the gold that is already mined and available through coins, bars. So, friends, this is how the supply-demand dynamics of gold is today. Now, I have thrown a lot of numbers. If you ignore all the numbers, I just want you to put a pin on two concepts which we will cover in greater detail in the rest of the video, and that is very important to understand why gold is a great investment. Concept 1, the demand for gold from governments, central governments. And concept 2, the recycling of gold that happens to meet the annual demand of gold, the 900 tons that I spoke about. Yeah. These two concepts, I would request you to put a pin on it because we'll come back and revisit it later. So that's how overall the supply-demand dynamics of gold is. 4,400 tons, growing 0.5% annually, 3,500 tons met from mining, and 900 tons roughly. If you look at the gold prices, the history of gold prices, you will see that the 80s and 90s weren't too good for an investor in gold. The gold prices fluctuated a lot from almost minus 30% to plus 30%. In fact, if you look at the entire 20-year period from 80 to 99, gold prices delivered negative returns, that is a loss, in 12 out of the 20 years. That is 60% of the time people lost money investing in gold. So it's a very, very bad phase, very fluctuation, very volatile. If you were a gold investor, your stomach would have been just churned. That was 80s and 90s. But then something very interesting happened in 1999. In fact, if you read about gold as a great investment, most articles, most people, the videos that you see will talk about very superficially about how gold is a safe haven, how gold stabilizes, why you should invest in gold. But rarely people delve into the history of what changed in 1999, which is what we found in our research. In 1999, the central banks, a handful of influential central banks of the world, when I say central banks, in case you don't know, it's like Reserve Bank of India, Federal Reserve of US, Monetary Authority of Singapore, these are all MAS, as you call it, and these are all the central banks, the bank of the government, or the government, for example. They got together and signed a gold agreement. Don't bother about the numbers and the charts and all I'm putting it here. Just go with the flow. You can find all of that in a detailed article on My 10th Cent. The link is there in the description. So just go with the flow. Don't bother to note down any of the numbers. So I was saying the central banks in 1999 got together and signed a gold agreement. What they basically said in this agreement is, whenever they have to sell gold, they will sell in a coordinated manner. The gold sales will happen in a coordinated manner. This singular activity transformed the gold market. Why? If you remember earlier in the video, I said the demand for gold, roughly 50% goes into jewelry. That's the kind of a sticky demand. It's a buy and hold. People buy jewelry, they typically keep it in their locker, and that's it. You don't really go out and run out your sell jewelry because gold price is up or down, right? So just one-way traffic mostly. The remainder of the traffic, that is 40-45% to 50% that is there, central banks of the world are a huge chunk of it. A majority, a big part of that comes 15, almost 50% of the remainder comes from central banks. So when central banks decided to act in a coordinated manner, it brought a lot of stability into the gold market because they were the practical, real buyers and sellers at that point of time. First big movement in gold market. The second thing that changed in the gold market, the emergence, the development of financial instruments to invest into gold. Prior to 2000, most of the way of buying gold for people like you and me was to just go to a jewelry shop and buy gold bar and gold coins, right? and just put it in your locker. But from 2000 onwards, you could start investing in gold the way you buy a mutual fund unit or a share. It's called exchange traded fund. Again, don't bother if you're not familiar with ETFs and how to buy gold as a mutual fund. All of that is covered in a separate video. Just go to our playlist, you can find that, or in the description. But you could start investing in gold in a financial way, right? And in the last 20 years, gold ETF investments has grown manyfold. So together, the central bank gold agreement and the digital or the financial way of, not digital, the financial way of investing in gold transformed the gold market. It transformed it to such an extent that if you look at the next 20 years, that is 2000 to 2020, gold went into negative zone only 4% of the time. 4 years. 4 out of 20, that is 20% of the time. Whereas in 90s and 80s to 2000, 80 to 2000, the 20 years there, gold was in negative zone 60% of the time. In 2000 to 2020, gold went into negative zone only 20% of the time. Huge change. In fact, in this generation, especially post 2010, gold is viewed as a very safe and stable asset. In fact, people will be advising you that always invest a little in gold because when stock markets don't perform well, gold will be performing good. It's a stable asset. The genesis for that is because of these two singular large events which happened in 1999 onwards. And as a result of that, today we have a view that gold is a stabilizer. It stabilizes. And when we went and we did a research, we found that if you look at the dot-com crisis, the subprime crisis that happened, the European debt market crisis, and even the COVID crisis now, you look at the tables, right? Whenever the markets have performed horribly and had losses and you've lost money, gold has always come back and stabilized and given you positive returns. In fact, that does not mean that when Sensex or stock markets are doing well, gold performs badly. Even then, gold does well. So, gold started behaving like a good stabilizer to the portfolio where in good times also they deliver positive returns and in bad times also they are delivering positive returns. And then the whole fascination for gold started even more increasing. Our old fascination became even more. So historically, this is how gold has performed. Now, it's very natural at this point to think, wow, if Manoj is saying gold is going to do well in good times and bad times, then why am I bothering with stock markets? Let me go ahead and invest all my money in gold. Right? It's a very large, that's at least what I thought. For that, we need to compare how gold performs with respect to the other asset classes. Then we get answer to the question, is gold a great investment? We will cover that shortly. In the meanwhile, if you've liked the video so far, please do give us a thumbs up button. Please subscribe to our channel. That's what motivates us to create more such videos. Now let's look at how gold performs versus other assets. We compared gold with other investment options that you have available today, such as Sensex, large cap mutual funds, small cap mutual funds, mid cap mutual funds, debt mutual funds, fixed deposits. We even threw inflation into the mix. We just wanted to see how gold is performing against all these investment options you have available. We have not kept shares. Shares we've kept outside because we don't know which share will perform well, which may not perform well, and all of that. Yeah, against the major investment options. And for the 5 year that ended December 21, gold was right at the top. And I was like, wow. So here I have an investment which is doing well in terms of crisis. It is also doing okay and reasonably okay and pretty good actually in good times, recovery phases. And for a 5 year period ending December 2021, it's right at the top. What more can I ask from an investment? But, like I said, I've been in the markets for a long time. Something was not looking right, So we went back and extended the period of analysis to 10 years. So 10 years ending December 20. Again, we compared against all the same asset classes that I just spoke about. In that situation, gold was right at the bottom. Okay. That was very strange and surprising. How can something which is performing well in bad times, performing well even in good times, on a 10-year basis be the worst performing asset? Which actually then made me stop and take a pause at what are we really looking at gold? What has gold really going for it? Why has gold performed bad in the long term? That's when I realized 2-3 interesting things. See, when you look at a mutual fund which invests in a share, what is a share? Share is ultimately a company which is performing consistently, delivering profits, growing the economy, making a difference. If you look at a debt mutual fund, it is investing in the bond again of a company which has borrowed money from you, which is paying you interest on time, growing their business, paying you interest, repaying your loan. Ultimately, all these investments, even a fixed deposit when you give it to a bank, is closely linked to the underlying economy. There is progress happening. But when you look at gold, there is no underlying use. Nothing gets produced, and gold doesn't make any difference to what is happening, the economic activity around us. Gold is really a way for us to manage our fears, and hence they do well during crisis. Gold is actually a currency. In fact, we have covered this in great detail in the video, Why Are We Fascinated About Gold, on why gold is a currency. If you've not seen it, I would urge you to watch it. So gold is really a currency. And that is the challenge why on a long-term basis, when all other assets have performed very well, gold has been very unpredictable. To be fair on gold, gold has only 2 things going for it. One, as a currency, as a universal currency, when things go wrong, people take safety in gold. And things will always go wrong. If there are good times, there are bad times. If there is a boom, there is a bust. So you'll always find these cycles happening and people will run to gold. That is one thing positive for gold. The second thing is the supply of gold is limited. So over a period of time, this commodity supply keeps coming down. The cost of getting gold out is also going up. The extraction cost of gold is going up every year. So naturally, the price of this commodity should also go up. These are the 2 things which are positive for gold. But on the negative, because gold does not produce or is not used in the production of anything practically, gold is a way of managing fears. And because it is a currency, there are too many geopolitical aspects that influence the gold. Like, for example, earlier in the video, I had said how central banks of the world signed that agreement, and after that, the gold market stabilized. That agreement is not in place anymore. They renewed that agreement till 2019. After that, they haven't. Okay. Tomorrow, if China, US problems start going away or start settling down, will China or Russia continue to acquire so much gold? I have no idea. Right? Will exchange traded funds continue to buy gold, or will they start getting excited with something else and move from gold to some shares or commodities or crude oil? I don't know. There are too many fluctuating geopolitical aspects which are unpredictable as an investor, and that goes against gold. So all in all, if you look at the positives and the negatives, you cannot call gold as the best investment that we can jump into. If you put the pluses and the minus, what at least I have come with is 2 things. Have some gold in your portfolio, because gold tends to do very well during crisis, and for the reasons explained that earlier, there is enough empirical data to support it. But in the long term, it's very difficult to say gold will perform very well compared or outperform compared to equity mutual funds. In fact, equity mutual funds should be the growth multiplier of your portfolio. Never replace that with gold. You can possibly replace your debt mutual fund, a part of it, with gold, maybe 10-20%, so that when things are performing in a very bad manner, when performance is very bad, gold will just ensure it stabilizes the portfolio. But otherwise, while gold has had a great run in the last 20 years, there are too many geopolitical aspects that influence the price of gold. So, friends, I hope you like this video. Please press the like button. Please subscribe to our channel. That motivates us to produce more such videos. And at My 10 Cent, we focus on high quality analysis for all our subscribers. Thank you. In the next video, we will talk about how to invest in gold. What are the options you have available today? Bye-bye.